Becoming a Crorepati. For so many of us, that's the ultimate financial dream, right? But does it have to be just a fantasy, something that only happens to a lucky few? Or is there a real, achievable path to get there? Well, today, we're going to find out.
When you think about building that kind of serious wealth, your mind probably jumps to a couple of extremes. Either you hit the jackpot, win the lottery, or you get into that high-stress, high-risk world of trying to pick the next big stock. But what if there's another way? A quieter, much simpler approach.
And that's really the big idea we're diving into. The path to a crore might not be about luck or risky bets at all. Instead, it's built on three really simple things: discipline, a whole lot of patience, and the tool called an SIP. Okay, so let's get into it.
So what on earth is this tool? Let's break down exactly what a systematic investment plan, or SIP, is all about.
Okay, think of it like a subscription for your financial future. It's super simple. You just pick a fixed amount, let's say a few thousand rupees, and that money gets automatically invested for you every single month into mutual funds. And remember, mutual funds are just these big baskets of stocks from lots of different companies. The real beauty of this, you're not trying to be a genius and guess when the market is high or low. You just invest consistently, month after month, year after year.
All right, let's get to the part you've been waiting for, the actual numbers. How do these small, regular investments possibly add up to 1 crore? This is where that big dream starts to look like a real, concrete plan.
And what's amazing is how simple the formula is. We're talking about a monthly investment of 10,000 rupees. Now, we're assuming an average annual return of 12%, which, just so you know, is a pretty reasonable expectation from equity mutual funds over a long period of time. And the last ingredient, maybe the most important one, you do this for 20 years.
So let's do the math. Over those 20 years, the total amount of money that actually came out of your pocket, the money you put in, adds up to 24 lakh rupees. That's 10,000 a month for 240 months. Now that's a lot of money, for sure, but it's nowhere near 1 crore. So where does the rest of it come from?
And here it is. This is the big aha moment. That 24 lakh investment just left to grow for 20 years at that 12% return. It doesn't just grow, it blossoms into a final value of just over 1 crore rupees. I mean, look at that difference.
So this is the crucial point to understand. You don't actually save a crore. You invest a fraction of it, and then you let the two most powerful forces in finance, time and the absolute magic of compounding, do all the heavy lifting for you. Let's take a closer look at how that actually works.
See, this whole thing isn't about speed, it's about endurance. The real engine driving this growth is something called compounding. And all that means is that you earn returns not just on your money, but on the returns you've already made. Your money starts making its own money. It just needs time.
And this timeline just shows it perfectly. In the first 5 years, growth feels, well, kind of slow. By year 10, you start to feel some real momentum building. But just look at what happens after that. The jump between year 15 and year 20 is massive. Your money isn't just growing anymore, it's accelerating. It's like a snowball rolling downhill.
This might be the single most important lesson in all of investing. The first decade, that builds the foundation. But the second decade, that's when you build the skyscraper. This is exactly why patience is non-negotiable. If you quit early, you miss out on the most explosive part of the growth curve.
Okay, so the math makes sense, the principle's clear, but how do you actually get started? Let's move from the idea to a simple, actionable blueprint you can use. Here are 5 simple rules to live by. First, start as early as possible. The more time your money has, the crazier compounding gets. Second, when you get a raise, give your SIP a raise too. This will supercharge your journey. Third, do a little homework and pick some good equity funds with a solid history. Fourth, and this one is so important, do not panic when the market drops. When prices fall, your fixed investment is actually buying more units for the same money. It's like getting your investments on sale. And finally, always keep your eye on that 20-year prize, not the daily noise.
This quote just flips the whole thing on its head, doesn't it? It's not about having a ton of cash to begin with. It's about having the discipline to start with what you have and letting that discipline make you wealthy over time. And that really leaves us with one final thought. The power of compounding is a force that rewards action. So while the goal of becoming a Crorepati might feel huge and far away, the journey doesn't start with a lottery ticket. It starts with a single, simple, systematic step, one that you can take today.